After flirting with death 3 years ago, carmakers face another grim year in 2012 as European consumers postpone buying new cars. The car market in Britain, Europe's third largest after Germany and France, shrank by 4% in 2011, and forecasters expect it to drop by at least that much again this year. With the economy shrinking, consumers are pulling back spending, and for most people there are fewer big-ticket items than a new car. As reporting season gets underway, Europe's mass-market car makers are likely to report lower earnings because of the impact the sovereign debt crisis is having on consumer confidence. France's two car makers, Renault and Peugeot, are among the most vulnerable to the downturn because they specialize in smaller, less profitable cars. However, the whole industry is feeling the pinch because everyone is offering big discounts on their cars in order to drive sales.
I think competition is very stiff. All the manufacturers obviously want to have the best possible number of volume units in the marketplace for retail, but I do believe that everybody is also looking at both volume and profit in their budget aspirations for last year and this year.
The industry survived the financial crisis thanks to scrappage subsidies and bailout loans like the €6 billion France gave to Renault and Peugeot to keep them from going under. While the state aid and cash for clunkers helped to keep car plants open, it also meant that car companies were not forced to undertake the kind of restructuring the industry needs. So Europe's car industry now has the capacity to make millions more cars than people actually want to buy, hence the big discounts on offer.
Car makers produce some of the most technologically sophisticated products in the world and then sell them like so many discounted sofas. In Europe, the business is looking increasingly unsustainable.
But even with these big discounts, consumers aren't exactly flooding into showrooms. And now, with the market slowing, the industry can no longer afford to subsidize sales anyway. In order to remain profitable, Renault said last month that it was cutting 5 cars out of the lineup it offers in the UK and reducing the number of dealers it has by about a third, from 190 to about 135.
I believe the challenges coming from incentives and pricing this year will be bigger than last year. We believe government incentives have eroded pricing even more in Europe. The customer doesn't really care where a discount is coming from, but I think educating consumers to a lower selling price is not a good thing, so mass market pricing will be tougher as a function of previous scrapping programs.
It isn't all bad news for Renault. While Europe is a difficult place to sell cars, the French producer achieved record sales of 2.7 million worldwide last year, thanks mostly to big gains in emerging markets like Brazil, Russia, and India.
I think Renault's European business is certainly at risk from the slowdown in Europe this year. Fortunately for Renault, they have a strong and profitable international franchise to offset that European weakness. The maker we think most at risk this year in Europe is Peugeot, who are very dependent on Europe for their profitability.
And in the upper end of the industry, premium brands like Audi, BMW, and Mercedes are still solidly profitable, thanks to their big exports out of Europe and strong brands that mean they have enough pricing power not to have to discount.
We believe European luxury car makers are facing different challenges than mass makers. Obviously, they're still exposed to the European market, but to a better customer base than mass makers in our view. And also they're benefiting from an ongoing growth trend in the emerging market world and the wealth creation in emerging markets. Strong brand equity is the key word here. And in addition to that, they should benefit from a stronger US market and also from a weaker euro this year.
With Europe's car market still struggling, producers are counting on other regions of the world this year, including the US, where the car market is growing by about 10%, and the industry was in a bullish mood at the Detroit Auto Show earlier this month.
But even in the best scenario, car companies are going to struggle to get people into showrooms in Europe this year. John Reed, Financial Times, West London.